Six main types of business organizations in the United States. First, sole proprietorship. Second, partnership. Third, business corporation, C Corp, S Corp, B Corp, closed corporation. Fourth, limited liability corporation, LLC. Fifth, non-profit organization. Sixth, cooperative. Hello, friends. This is Advocate Sanjay Arora. I welcome all of you to my YouTube channel, Legally Determined by Sanjay Arora. Let's us get started. First, sole proprietorship. The vast majority of small businesses start out as sole proprietorships. These businesses are owned by one person, usually the individual who has day to day responsibility for running the business. These sole proprietors can be independent contractors, freelancers, or home based businesses, etc. The features of the sole proprietorship: number one, the owner receives all the profits. Second, the profits are taxed only once as personal income of the owner. Third, the owner is in complete control of the company. Fourth, the owner has unlimited liability. Even the owner's personal assets are at risk. Fifth, the sole proprietorship has no separate legal status. Sixth, the sole proprietorship ceases to exist on the demise of the proprietor. Seventh, the sole proprietorship is the easiest and the least expensive form of ownership to organize. Eighth, the sole proprietorship is limited in raising funds and may have to acquire consumer loans. Second, partnership. In a partnership, two or more people share ownership of a single business. Like proprietorships, the law does not distinguish between the business and its owners. The partners should have a legal agreement that sets forth how decisions will be made, profits and losses will be shared, disputes will be resolved, how future partners will be admitted to the partnership, how partners can be bought out, or what steps will be taken to dissolve the partnership when needed. The partnership is required to file an information return to the government to report what the profits and losses of the partnership were and how these were allocated to the partners. Since the liability of partners is joint and several, and particular partner can be made to pay the entire debts of the partnership regardless of the allocation of profits and losses or capital contributions made into the partnership. A partnership ceases to exist when certain criteria are met, such as the death or bankruptcy of a partner, or if the partners decide to end the partnership itself pays no taxes. Partnerships have unlimited personal liability unless structured as a limited partnership. Partnerships have to pay self employment tax except for limited partners plus personal tax. Kinds of partnership. General partnership. This is the most basic type. It assumes equal partnership and therefore equal ownership. All management and liability is shared between the partners unless otherwise specified. Limited partnership, a partnership with limited liability. In limited partnership, one or more general partners manage the business and are personally liable for partnership debts, and there are one or more other limited partners who contribute capital and share in profits but who do not run the businesses and are not liable for the partnership obligations beyond contribution. Joint venture. This type of partnership is time based. Two or more individuals may work together for a particular project or for an extension of time. Upon completion, the partnership is dissolved. If the individuals would like to continue to work together after that, they would then register as general partners. Third, business corporation. A business corporation is a legal entity established by individuals under the laws of a state. A business corporation is more complex than a partnership or a sole proprietorship. In fact, by incorporating, a new legal person is created. A corporation is an entity that is separate from its owners, so that regardless of what happens to shareholders, the corporation continues until it is legally dissolved. Depending on state law, a corporation can be owned by just one person and have just one director and officer. The owners of a corporation are known as shareholders. The shareholders elect directors to set the policies of the corporation and represent their interests. The directors appoint the officers of the corporation to manage day to day operations. Corporations are legally required to follow more formalities than any of the other entities, including annual meetings of the shareholders and directors, as well as board approval of the most significant acts by the corporation. A corporation is separate from its shareholders. The corporation may make contracts, assume liabilities, sue and be sued. The corporation and its shareholders and directors have specific duties and obligations to each other. Liability of shareholders is limited to the amount of shares held by them. Shareholders can transfer ownership and trust. A business corporation has continuity until dissolved according to the law. On the basis of taxability, corporations can be broadly of two types. C corporations. A C corporation is a corporation that is taxed separately from its owners. It gives the owners limited liability, increasing more risk taking and potential investment. A C corporation has no limit on the number of shareholders, foreign or domestic. Shareholders are not required to be US residents, which allows for international ownership. Any distribution from the earnings and profits of a C corporation is treated as a dividend for US income tax purposes. Exceptions apply to treat certain distributions as made in exchange for stock rather than as dividends. Such exceptions include distributions in complete termination of a shareholder's interest and distributions in liquidation of the corporation. S corporations, an S corp or a special corporation is one that avoids double taxation faced by C corps. An S corp allows the profits and losses to flow directly through the owner's income so that it is not subjected to corporate tax. This type of tax structure is sometimes called pass through taxation. This pass through taxation allows shareholders who meet certain qualifications to claim corporate losses on their personal tax returns. All the states do not recognize them in a similar manner. Some states treat them like a C corp, and some states levy tax on them after their profit is above a certain limit. S corps can only have 100 shareholders, and it is mandatory that all of them are citizens or permanent residents of the US. The only entities allowed to be shareholders are trusts, estates, and some tax exempt organizations. It also embodies the characteristics of a C corp. It functions independently from its shareholders. B corp, a benefit corporation or a B corp, is a for-profit organization. It is driven by profit and mission. The B corp is accountable for doing public good along with earning profit. They are also required to submit benefit reports in some states to show their contribution to the good of the public. Their purpose and accountability is different from that of a C corp, but they are taxed in the similar fashion. A B corp social mission is monitored and granted by B Lab, a non-profit organization that assesses the social mission of the company. Every 3 years, B Corps must be recertified by the B Lab to maintain their status as a B Corp. B Corps pay the same taxes as other corporations and are allowed to elect either a C Corp or S Corp tax structure and provide the same liability protections to their shareholders. However, the benefit of the B Corp designation is that it provides a unique branding opportunity, attracting employees, shareholders, and others, and certain loan forgiveness for academic contributions. Closed corporations. Closed corporations are similar to a B Corp but are not as formally structured as one. That is how they eliminate many formalities that have to be undertaken by bigger corporations. It is run by a small group of shareholders and does not have a board of directors. Its shares are also not allowed to be traded in public. Shareholders of a closed corporation are not personally liable for the business's debt. However, there are exceptions such as when a shareholder has signed an agreement to be personally responsible for corporation debts. Fourth, limited liability corporations, a hybrid of a corporation with an ability to limit personal liability and a partnership with an ability to assess profits and losses to individuals. This type of organization provides a flexible structure. LLCs are extremely flexible and can be used for a very wide range of businesses. Like partnerships, LLCs can be as simple or complex as the members desire. Depending on state law, an LLC can have the same limited liability for members as a corporation or have some members with limited liability and some without limited liability, like a limited partnership, or even have no limited liability for any members, like a general partnership. Unlike corporations, some states requires that their LLC designate a date in the future at which the LLC will automatically dissolve. Some states also require that if a member dies, goes bankrupt, or meets some other calamity, the remaining members of the company must either dissolve or vote to continue. An LLC functions as a limited liability corporation, but is taxed and operated in a way that is most consistent with a partnership. However, one must ensure that a limited liability business does not have more than two of the four qualities that characterize a corporation: limited liability concerning assets, continuity of life, centralization of management, the ability to transfer ownership and trust. If more than two of these qualities are met, the limited liability becomes a corporation and is taxed accordingly. The primary characteristic an LLC shares with a corporation is limited liability, and the primary characteristic it shares with a partnership is the availability of pass-through income taxation. It is often more flexible than a corporation, and it is well suited for companies with a single owner. Fifth, non-profit organization. Non-profit organizations are ones that do not earn any profit and function just for the benefit of the society. Charities, educational institutions, religious organizations, etc. Some examples of it. These corporations are exempted from paying all kinds of taxes. The rules for non-profit organizations are quite similar to those for a C Corp. Additionally, they also have to disclose the usage of any profits that they might have earned during the year. A non-profit organization is an organization that uses surplus revenues to achieve its goals rather than distributing them as profit or dividends. While not for profit organizations are permitted to generate surplus revenues, they must be retained by the organization for its self preservation, expansion, or plans. Sixth, cooperative. A cooperative is a business owned by and operated for the benefit of the people using its services. Profits earned by the cooperative are distributed among the members, who are also known as user owners. An elected board of directors and officers run the cooperative, while regular members have voting power to control the direction of the cooperative. Members can become part of the cooperative by purchasing shares, though the amount of shares they hold does not affect the weight of their vote or the number of votes that they are entitled to. How to incorporate these bodies? The steps for incorporating the different kinds of organizations are somewhat similar, but a few requirements may vary from state to state. Most businesses do not have to register with the federal government to become a legal entity. They can just get a federal tax ID and be done with it. The following steps need to be followed while incorporating an entity in the US. First, a name has to be chosen for the entity. If it is a C Corp, then the words incorporation, incorporated, or limited should be a part of the name of the entity. Second, after the name has been chosen, a certificate of incorporation has to be filed with the Secretary of the State. The certificate will contain the name of the entity, purpose of the business, address of registered office, capital structure, etc. Third, a registered agent has to be appointed for taking this process forward. They will incorporate the company and be responsible for the legal work. This agent is usually the Department of State in the different states. Fourth, prepare bylaws that govern the internal organization of your business and serve the purpose of ground rules on how the business shall be run. Fifth, the incorporator who has signed the incorporation papers must appoint the first directors of the company and hold the first board meetings. These directors shall serve as the directors till the first annual meeting of the shareholders. They may or may not continue after that. Sixth, additionally, stocks are issued to every shareholder that has contributed to the business in any manner. These stocks are also known as securities under the laws made by the state. Seventh, further, any other tax requirements that have arisen should be fulfilled and all the compliances should be complied with. However, if a corporation is being incorporated in New York, they have to file an additional statement known as the biennial statement with the Department of State at the end of every year. These steps are generic in nature and can vary from state to state, especially things such as tax requirements and time limits regarding the performance of certain steps can differ. Most of the bodies that can be formed in the US can also be formed in India. LLPs, sole proprietorships, non-profit corporations, C-corps, companies, and cooperatives can be incorporated in India and have a similar structure as that of them in the US. However, the concept of an LLC does not exist in India. It is a very US specific type of private corporation. State tax ID and federal tax ID numbers, also known as an employer identification number EIN, work like a personal social security number but for your business. They let your small business pay state and federal taxes. Your state tax ID and federal tax ID numbers, also known as an employer identification number EIN, work like a personal social security number but for your business. They let your small business pay state and federal taxes. Your employer identification number EIN is your business's federal tax ID number. You need it to pay federal taxes, hire employees, open a bank account, and apply for business licenses and permits. It is free to apply for an EIN and you should do it right after you register your business. Your business needs a federal tax ID number if it does any of the following: pays employees, operates as a corporation or partnership, files tax returns for employment, excise or alcohol, tobacco, and firearms, withholds taxes on income other than wages paid to a non-resident alien, uses a KEO plan, a tax deferred pension plan, works with certain types of organizations. You can apply and receive an EIN immediately using the IRS assistant tools. It will guide you through questions and ask for your name, social security number or taxpayer ID number, and business structure. If you are a third party, you will also need signed authorization to apply. Your 9-digit federal tax ID becomes available immediately upon verification. Do not apply for an EIN on websites that charge a fee. The EIN application is free of cost. Change or replace your EIN. If you already have an EIN, you might have to change or replace it with a new one if certain changes have occurred with your business, depending on your business structure and the kind of change that occurred. In general, you need a new EIN when your business's ownership or structure changes. Deactivate your EIN. An EIN cannot be cancelled as it is an assigned permanent federal ID number. However, if you no longer need your EIN, the IRS can deactivate it if your organization is not exempt and you have filed all outstanding tax returns and paid any taxes owed. Receiving an EIN you didn't request. Occasionally, someone may request an EIN on your behalf for a legitimate business reason. If you receive a notice for an EIN that is not yours, the IRS recommends that you first confirm that it was not a legitimate request on your behalf. If you confirm that it was not requested on your behalf, report it using the IRS Business Identity Theft Affidavit. If your EIN was stolen, follow the IRS steps to report business identity theft. Get a state tax ID number. The need for a state tax ID number ties directly to whether your business must pay state taxes. Sometimes you can use state tax ID numbers for other functions like protection against identity theft for sole proprietors. Tax obligations differ at the state and local levels, so you will need to check with your state's websites to know whether you need a state tax ID. Research and understand your state's laws regarding income taxes and employment taxes, the two most common forms of state taxes for small businesses. The process to get a state tax ID number is similar to getting a federal tax ID number, but it will vary by state. You will have to check with your state government for specific steps. Thanks for watching this with Break a Leg. Thank you.